Looking at the results for January, it looks like the regional economy could be on the path to recovery.
It is on the path to recovery, Cindy. The overall index was up from last month. This is a January survey of supply managers in 9 states, which is a leading economic indicator of the area, and it was up, and I had to say pretty briskly. Now, I do think the recovery that's underway right now, is going to be modest, even with these pretty good numbers for the month. So I was very encouraged by the numbers. I mean, it's some of the best numbers we've gotten in a long time. I mean, this downturn, economic downturn, which began in December of '07, at least for the nation, is now, it looks like it's coming to an end, and the mend is now underway. And I think we're going to see some, it won't be great numbers, but we're going to see some pretty good job numbers. Well, pretty good is too strong a word. I'm thinking we're going to see okay job numbers.
Well, we did actually see a little bit of improvement in employment.
We did. Our employment index likewise is above growth neutral, so that was job additions. Now that's for the firms that we survey, of course. For the overall economy of each of the 9 states, and you put them all together, the region, we're still not really adding jobs. But the companies that we survey, which are leading economic indicators. In other words, this is right now for them, but it's going to be later on for the entire state economy, stretching from North Dakota and Minnesota to Arkansas and Oklahoma in the south. So we're getting those 9 states, and it's looking somewhat better. This month we asked the supply managers about layoffs, and we compared that number to November when we asked the same question. A lot less layoffs expected in this next for 2010. That's come down, so that's looking better. We asked about pay raises, and we're even seeing that turning upward more. A higher share of supply managers expecting a pay raise, and of course that's very good, although it's not as strong as we'd like to see. I mean, we're talking about pay raises for 2010. In my view, are probably going to come in at 3 to 4%, and maybe even a little bit lower than that. 2 to 3, maybe as high as 4%. Now that of course that includes inflation. So when it comes down to the real number, how much once you whack off that inflation number, you're probably looking at almost static. But in nominal terms, that would be not inflation adjusted. It's probably going to be up 2 to 3 to 4% for 2010.
But we are seeing inflation sort of lining that path to recovery.
Wow. An interesting part of the survey, Cindy. It was that number is up above 70, and that's certainly pointing toward, at least in the pipeline, and that's what we look at. And the Fed, of course, the Federal Reserve met last week, and they said, we see it subdued. Well, understand that they are motivated to make us all think it's subdued, because once that's all of us consumers believe, workers as well, believe that inflation's up, then we start, the inflation expectations get higher, and then it actually results in higher inflation. In other words, it's a self-fulfilling factors that we're seeing there. So the Fed, I think, if you really got them in and said, now tell me, Ben Bernanke, head of the Federal Reserve, tell me really what's going on. Get him a shot or two of Jägermeister at the same time, and get him in there and say, well, what do you think? He'd say inflation's up. And I think it is going to be up. It will be. Our survey is saying it. We're going to see it. We're going to see it up. Now, it's not the inflation of the 80s. It's the inflation of the 2010s, this decade. And it's probably going to be well above what the Fed intends. They'd like to see it growing at 1 3/4 to 2%. It's going to be 3 to 4%, I think, when it's all said and done. Now, that's still not bad, but it's not like the Fed says it is. I mean, they're motivated to make us feel a little better about inflation.
Are exports and imports also indicating sort of a recovery?
They are, Cindy. The new export orders were up above growth neutral, and of course that's good news. The trade deficit numbers that have been coming out, the most recent from the government, those were good. We ran a trade surplus with China. Now the overall deficit was still negative for the nation, but the overall exports were up. we're seeing new export orders growing. Of course, that's good for the economy, and it reflects just the rebound among our trading partners. So that was good. Imports are still not as strong, and that's not a bad thing. Imports still at 50, growth neutral, right on that 50, and of course that has a lot to do with higher prices for imported goods.
What else?
Well, I think the confidence index was solid. I mean, some of our surveys, I mean, we understand that we took the survey is internet based. We took the survey last week, and that would have been Monday, and then we resurveyed for those who had not responded on Friday. Well, Friday the GDP numbers came out. So that number, the U.S. GDP number, was up almost 6%, 5.7%. That's really good. So yeah, that probably pushed the confidence index number up. But we're all a little more confident. I mean, for goodness sakes, we look back to last year at this time. It was not a good economic outlook. So we're all feeling a little bit better now, and feeling like spending a little more, although the spending's still not as strong as we'd like to see. And then, of course, what we're seeing in other factors, new orders are up pretty briskly. That's up. That's important. But our delivery lead time index, that's how long it takes these supply managers to get their products, that's going up. What that is just another early warning, early signal of inflation in the pipeline. I'm an inflation hawk there. And finally, the final element I'd like to talk about is inventories. Down for the 16th straight month, but the down is getting less down. In other words, it's down, but not like it was. So that GDP numbers that came out Friday were mirrored exactly what we're seeing. In other words, pullback, the pullback in inventories, meaning reduction in inventories, but the reduction is less. So that adds to GDP. So before anybody gets really excited about that GDP number Friday, understand that almost 3% of it came from inventories just not as negative as they were in the past. That's hardly worth jumping up and down about. But still, it's better than the other side of it, which would, of course, inventories coming down even more. So it was a good report. The GDP report was good, much better than we thought. Our report, but all in all, when you put it all together, this economy is now on the mend. But boy, it's a painful mend. It's still not. We're seeing unemployment much too high. Not any new jobs to any great extent. So job growth is going to be modest.